When you're looking for investment properties to buy, especially if you're comparing multiple properties side by side, how are you supposed to know if one is better than the other? Especially if you're just starting out, you may be completely clueless when it comes to analyzing properties and knowing whether or not something is a good deal. Thankfully, there are some tried and true methods and metrics that real estate investors use to decide if something is a good deal and if it's something that we should pursue or not. There are a ton of different metrics that people use, but the three most common are cash on cash return, cap rate, and return on investment, or ROI. I know that some of these terms sound kind of daunting and you're unsure what they may mean, but that's the purpose of today's video, and I'm gonna go in and explain what they are, how you should use them, and the formulas behind calculating each and every one. If math isn't exactly your forte, there's really no need to worry because a lot of these formulas are really simple. We're gonna go over some sample numbers and show you how you can calculate the cap rate and the cash on cash return for your own investments. And if you stay tuned until the very end of the video, I'm actually going to go through some numbers on rental properties that I own myself, just to kind of give you an example of numbers in my area and how things kind of work out, and just to see how things compare. Welcome back to the channel, guys. We are so glad you're here. I'm Bryce with Sane Sense, where we talk about everything money, real estate, and how to achieve financial independence. If you like content just like this, be sure to give me a thumbs up down below. And if you love content like this, be sure to hit the subscribe button down below as well, so you get notified each and every week as we post new content. It really does make a difference when you like and subscribe, so if you haven't done so already, please do so. So first and foremost, why is it important to understand all these different terminologies? And I think the answer to that is fairly obvious, but basically if you run the numbers well, it'll mostly guarantee that you won't get screwed on a real estate investment deal. At the end of the day, everything comes down to the numbers. If the numbers work out on an investment deal, then we buy it. And if the numbers don't work, then we don't buy it. By understanding some very basic terms and the math behind it, you can really just ensure that everything is going to go smoothly, that you really are purchasing a good deal, and that you don't get tricked by somebody else saying that it's a good investment when it really isn't. When you run the numbers yourself, you can ensure that everything is going to cash flow and that it will be a positive investment for you. The first metric that we're going to talk about is something called the capitalization rate. That's kind of a mouthful, and so you'll hear a lot of people say cap rate for short. And once you understand what a cap rate is, you can be cool like all the other investors who say, oh yeah, that property over there, that's an 8 cap. Oh, that property, that's a 12 cap. It sounds complicated, but I promise you that it's not. The cap rate is really just the ratio of net operating income to the fair market value. Or in even more simple terms, cap rate is just the amount of money that a given property brings in compared to how much the property is worth. So the formula for this guy is really simple. It's just cap rate is equal to the net operating income divided by the fair market value, or the value of the property. Now, like always, let's run some numbers, shall we? Let's say we're wanting to purchase a duplex that is valued at $200,000. If the net operating income for this property is $20,000 and it's valued at $200,000, then you take the $20,000 divided by $200,000 and we get 10%. So this property could be referred to as a 10 cap. Now, you're probably asking, okay, that's easy, but what is net operating income? Net operating income is all of your income minus expenses, excluding the mortgage. So to calculate this, it's really, really simple. All you do is you take the gross rental income and you subtract out all of the expenses. You subtract out vacancy, property taxes, property insurance, maintenance and repairs, any common utilities that the landlord has to pay, and really just any other expenses that are coming out of your pocket. And again, remember that this does not include the mortgage. You may be asking, well, why is the mortgage not included in this formula? And the reason for that is because cap rate is focusing particularly on the property itself as the investment and doesn't want to take into account any financing whatsoever. Financing can vary so widely depending on who's purchasing the property. So you may be an all cash buyer and you can come in and then there's no financing whatsoever. You could be putting down a 50% down payment on a property, or somebody else could come in and be putting a 10% down payment. It just, those numbers and the different financing options that are available, that can make your mortgage so much different than the person next to you. So like I said, the cap rate, it focuses just on the property and not on the financing whatsoever. By excluding the mortgage or the financing or whatever it may be, we look at the profitability of the property itself and leave everything else out of it. When it comes down to it, the cap rate is really just an easy way of comparing property A to property B and seeing which one really pans out to be the better investment for you. The next question that I know everybody's going to be asking is, what is considered a good cap rate? And that's kind of a hard question to answer because it varies so widely depending on your market, where you live, and there's a lot of different factors. But typically speaking, a good cap rate to shoot for is anywhere between 4 to 12% or more. And of course, obviously, the higher cap rate, the more money that you'll be making. Another metric that a lot of investors use to value a property is something called cash on cash return. This is the relationship of a property's cash flow compared to the initial cash investment that was used to acquire the property. Or in more simplified terms, how much money am I going to make compared to the amount of money that I have to put into this property? So the formula for this guy is cash on cash return is equal to the cash flow divided by the initial cash investment. The ICI, or the capital investment, is more than just the down payment that you put down on the property as well. This includes any rehab costs, any closing costs, just the large lump sum of money that you had to put down to acquire this property in the first place. Cash flow is a really simple one, probably doesn't need a lot of explaining, but it's just the money that you get to keep after all of the expenses and the mortgage are paid for. That's everything that you get to keep in your pocket. So let's run some numbers again, because obviously I like numbers. Let's say we have an investment property that we purchased for $100,000. We used 20% as a down payment, so that's 20 grand. And then there was maybe $3,000 in rehab costs and $2,500 in closing costs. Adding all that up, that brings our initial capital investment to $25,500. As far as the cash flow goes, let's say we have a tenant in there and they're paying us $1,000 a month. By the time we subtract out the mortgage and all the expenses and vacancy, maintenance, everything accompanied with that, let's say we just have $250 per month net left over. $250 times 12 months is $3,000. Take that $3,000 and divide it by our initial capital investment of $25,500, and we come out to 11% cash on cash return. Similar to the cap rate, cash on cash return is a really good way of comparing two properties side by side. The thing that cash on cash is not good for is calculating the return on your investment over a long period of time. Let's say, for example, that you keep this property for 10 years. Hopefully over the course of that 10 years, your rents have gone up, and also hopefully your repairs and vacancy and a couple of other expenses has gone down. Cash on cash return it doesn't account for that very easily. And again, I'm sure you're asking, okay, what's a good cash on cash return? Again, there's a lot of different variables and things, change here and there, but typically speaking, a good cash on cash return is anywhere between 12 to 15% or higher. The third and last metric that we're going to talk about today is simply return on investment. This is very similar to the cash on cash return, except that it takes into account a few more items. When you're calculating cash on cash, you don't include a lot of real estate benefits such as appreciation, the tax benefits, and you also don't include the principal paydown. With ROI, or your return on investment, we take all of this into account. I wish there was a really good, easy, simple formula to calculate ROI, just like cap rate and cash on cash, but there's a lot of little things that go into it, and you have to calculate all of these things separately and then add them back together. So it's really not as easy as the other formulas. Rather than pulling out an Excel spreadsheet and running the amortization chart and doing all the calculations, I typically just stick with cash on cash return. And then I know that once I calculate my cash on cash return, my ROI for the whole investment is typically just going to be higher than that. So that's maybe not a good answer or the answer that you were looking for, but I know that if my cash on cash return is good, that my ROI is going to be even better. At the end of the day, all I really care about is making more than the 8 or 10% that I would make in the stock market. Another metric that's not discussed very often, but one that I personally like to use, is net cash flow per door. For myself personally, I try and shoot for $250 per door per month. Again, this varies wildly based off where you live. I live in a low cost of living area, and so my numbers are most likely going to be higher than a lot of you watching. I think it's important to mention too that you definitely shouldn't use just one of these metrics. Typically speaking, I will use 2 or more of these on an investment property just so I know for certain that I'm getting a good deal. And most often I use net cash flow per door, and I also use cash on cash return. If you only use one of these metrics, you may be getting a great cash on cash return, but when you look at the net cash flow per door, you might only be making $100 per month per door. So say I'm buying a duplex, if that's the case, I'll have great cash on cash, but I'm only making $200 net per month for that entire property. And in my opinion, that's just not worth the headache. It's not worth the hassle of managing tenants and doing maintenance. And I mean, it's just for $200, it's not worth it. So take that with a grain of salt, but I highly recommend that you use 2 or more just to make sure that your investment really is safe and sound. If I had to pick just one of these, I would definitely rely on cash return. That's typically my favorite and the one that has brought me the best deals over the years. I really like it because it's simple and it's easy, and it's really easy just to scribble on the back of a napkin and decide if it's even something that's worth pursuing. And then if it is something that's worth pursuing, I'll dump it into a more advanced spreadsheet, do some more numbers, and really make sure that it's something that I want to pursue before, investing any more time and money into pursuing that property. Now, before we go, I promised that I would run through a couple of numbers on properties that I currently own, just to show you guys how they compare and just to kind of give you an example idea of how this would look on an actual property. Keep in mind, again, that I live in a low cost of living area, and so these numbers may not compare to where you live. You'll have to run your own numbers. So starting with property number 1, this was the very first property that we ever purchased, and I'm still to this day kind of amazed that we were able to get it because it cash flows so well. It has the highest returns on any of the properties we've ever owned, so it's pretty remarkable. Anyway, the property value right now currently sits at $140,000. We bought this for $93,300. The down payment and closing costs came to $5,555. And the property was a little beat up, and so rehab before we could get new tenants and everything in there came to around $3,500. Right now, our net cash flow for both doors is $736 a month. That means that our net cash flow per door is $368. Net operating income is $12,336. Now, when you punch in all these numbers, the cash on cash return comes out to 97.5%, which I realize that's really high. But like I said, the numbers on this property just worked out so well that we could not pass it up. And when you run the numbers on the cap rate, that comes out to 8.8%. Moving on to property number 2, the property value currently sits at $165,000. The purchase price on this guy was $133,000. The down payment and closing costs came out to $15,341. This property was really great. Everything was in perfect condition and there were 0 rehab costs. The day that we bought it, we could get new tenants in there and it's been smooth sailing ever since. Total net cash flow between the 2 doors is $568 a month, bringing the net per door down to $284 per month. Net operating income is $12,780, and when you calculate cash on cash and cap rate, that comes out to 44.4% and 7.7% respectively. Now, look at these 2 properties and compare them. The cap rates are actually really close. 8.8% and 7.7%, those are very comparable. But when you look at the cash on cash return, property number 1 is more than double that of property number 2. And it's reasons like this that I use multiple methods of analysis to make sure if something is a good deal or not. If you look at just the cap rate alone or just the cash on cash alone, you could be missing a lot of things because properties they vary so widely between each other. I hope that all that makes sense. I threw a lot of numbers at you, but like I explained, it's really not that complicated. The math behind it is really simple. And if you can get the hang of that fairly easily, it's gonna benefit you a lot when you're out there looking at deals and investments and trying to decide if something is worth pursuing or not. If you're confused about anything or you have questions about the math or really anything about this video, feel free to comment down below and I'd love to help you out. Also, I'd be curious to see, for those of you who already own some real estate, what your cap rates have turned out to be and where you live in the country, to just kind of see how we compare. Anyway, that's it for this video, guys. I really appreciate you guys watching. Like I said, if you have any questions, please comment down below. As always, please give me that thumbs up if you liked what you see. And as always, please be sure to subscribe down below as well if you haven't already. Thanks so much for watching, guys. We will see you next week.